afternoon. Thank you for joining us today for our webinar on long-term care. Before we kick things off, just want to go over a few things. First, my name is Josh Antis. I'm the Financial Education and Community Partnerships Manager for CalCoast. Hope everyone out there is doing well and staying safe. So a few quick things. Just want to mention that everyone's line will be placed on mute for the duration of the presentation today. However, if you do have any questions, we want to answer those for you. So please include those in the chat or in the question and answer box, and we will answer those as we go or at the end of the presentation today. Also, if you haven't already checked out our website, please do. We have a lot of great financial wellness tools available to you at calcoastcu.org. I'll place that link in the chat for you at some point during today's presentation so you can take a look at that. And also, this is being recorded, and we will post this recording on our YouTube channel. So don't worry about taking too many pages of notes. You can always go back and take a look at the video and catch anything that you might have missed. So with that, I'd like to go ahead and turn things over to Kyle Johnson. He's a certified financial advisor with California Coast Financial Services, and he's going to help us to kick things off today for our webinar.
Thanks, Josh. Appreciate it. So I am a financial advisor with CalCoast. I've been in the industry for about 8 or 9 years. I've been with CalCoast for about 4. But as a financial advisor, especially with our members, one of my biggest roles is to help members plan for retirement. A big part of retirement, I would say maybe one of the biggest issues that could disrupt a retirement plan, right, and blow up a whole retirement plan is really long-term care. It's one of the most expensive things that you could kind of run into, and especially, it can be an extended period of time. So as part of our holistic financial planning, typically the long-term care conversation comes up. And when we do have a long-term care need, or if we have somebody who is interested in having that conversation with us, we like to rely on some of our experts in the field to work for our members to try to find the type of long-term care that's best suited for them at a price that they can afford, right? That fits in with their retirement plan nicely. So I'll go ahead and I want to introduce Zach. Zach has been in the industry for 23 years. He is a wealth of knowledge, and he's one of our resident experts in the field of long-term care. We rely on him to, among others, to help our members to find policies that fits within the plan that we've created for them. So with that, I'll go ahead and turn it over to Zach, and he's going to introduce himself and talk a little bit more about different types of long-term care, a lot of the basics, maybe some things you knew and maybe hopefully some things you didn't. So Zach, go ahead.
Thank you, Kyle. There we go. Can you see that okay?
We got you. Yep.
Excellent. Well, thank you, Josh, and for creating this event. Thank you, Kyle, for inviting me. It's awesome to be here. And I know when sometimes the initial inclination when we think about long-term care insurance is that this conversation may be a real snoozer, but I'm going to do my best to prevent that. And hopefully, like Kyle said, while today's conversation isn't advice, hopefully I'm going to share some information that'll maybe change how you look at the long-term care planning decision, and really talk about how we use insurance as a tailored way to really prepare you and your family for that event. The last couple of years with the COVID pandemic has really created put a spotlight on nursing homes and the elderly and how they were impacted. And it's really created a lot of urgency from retirees and pre-retirees to really determine, fortunately, I was not impacted this time. How do I plan today to make sure that my family and I are prepared if this were to happen again, or if I needed long-term care? So ultimately, there's no reason to be, have any aversion to having the conversation about long-term care planning. I encourage you to reach out to Kyle and talk to him about the questions or the conversations that this may spur with you and your spouse or significant other after the call. And like Kyle said, long-term care planning is simply another part of the overall financial plan. I like to refer to it in an analogy as it's like you're building a moat around your castle, really protecting what you've worked for. Now, if you have long-term care planning discussion with Kyle, what I think that's going to give you the ability to do is pressure test an LTC event today. Make sure that your understanding and expectations of what an LTC event could look like is true, and that the consequences that you anticipate are also accurate. Okay, so this gives you the ability to go through the event today, determine how prepared you really are, and then determine what type of corrective action or changes should you take. Okay, one of the most important things that you protect with long-term care planning are things like your retirement income, spousal retirement income, and ultimately your legacy plans for your assets and for your family. What we wouldn't want is at the very end of life for all that we've worked for and prepared for to be changed or in any way compromised simply due to something like long-term care that we know can affect any of us. And the longer we live, the more likely we are to be impaired by it. Now, I think that there are a lot more than 4 reasons to consider long-term care insurance as part of your financial plan, but we're just going to talk about 4 of the top ones today. And, number 1 is about maintaining control, right? Ultimately, with a long-term care insurance plan, you're able to make sure that you're able to maintain control of where you get your care, i.e., meaning that you have prepared for those expenses should you need care at home or in a long-term care facility. We're going to talk more about how individuals that need care progress through the continuum from home into assisted living into nursing home. But ultimately, long-term care insurance is going to provide you control over what happens down the road. It's also going to help you maintain your independence and dignity. Now, when I say independence, that really comes down to not being a burden on your family by either them having to change their goals and their lifestyle and habits, i.e. maybe them having to move in with an adult child. That's really maintaining your independence. Where will you be? Maintaining your dignity really has to do with the concept of, even if you do have family members who are there that are willing and could take care of you, are those areas that you actually want them to have to perform and take care of you? Finally, number 3, it's going to help you protect the nest egg that you've accumulated for retirement income. And kind of like Kyle alluded to, if we think about our retirement as the golden goose, and then each month it provides that golden egg, we don't want to start having to trim down our goose, otherwise our golden egg gets smaller. So by having long-term care insurance and then having this source that will help meet those expenses if you need care, we're protecting everything that you've worked for throughout your career into retirement. And then lastly, when you put a long-term care insurance plan in place, you help answer a lot of the questions so that your family won't have to. Okay, and what I mean by that is, ultimately, when you need care, sometimes you are no longer involved in the conversation. So these decisions are being made by spouses, adult children, different stakeholders in your overall well-being. So ultimately, when we're looking at long-term care planning, some of you may just want to have a plan so that you get to answer those questions now, and it makes it a lot easier to keep the family together in the future. For the longest time, there were only 2 options when it came to what do you do about long-term care. You would either go into self-insure, which meant that you would be responsible for all of the expenses if you needed care, or you could use a standalone long-term care policy that would pay LTC benefits in the event that you suffered long-term care. What we've seen is a lot of development and advancement in the area of long-term care planning. So now you have a third option, and I'm going to walk through these real quick. When we think about self-insuring, we're simply meaning there's no insurance involved. You hedge all of the risk on your own. So if you need long-term care in the future, you're simply going to pay it out of your savings or investments. Okay. The pros to that are that you're not paying any premiums, but the downside to that is that if your long-term care expenses are greater than you anticipated, or if you need the care longer than you anticipated, you run the risk of spending a lot more money than you thought. Okay, this gets into retirement income questions. This then gets into your legacy questions. So if you don't want to face that range of outcomes, the next step is looking at standalone long-term care. And when we talk about standalone, we're really talking about the traditional long-term care approach that maybe you looked at 10, 15, or 5 years ago. This is where you pay an annual premium or a monthly premium. And if you need care, the company pays you long-term care benefits. That part of it, most people agreed with and understood. The two downsides to the traditional long-term care was that, number one, premiums could increase over time, and they have. And then number two, if you ultimately were lucky enough to never need long-term care insurance, the premiums you paid were forfeited to the insurance company. So that really left retirees with a tough decision. Do I use a plan that maybe I have an aversion to, or do I just go it alone and take all the risk themselves? The third development that's happened in the last decade in the long-term care industry are development of hybrid long-term care policies. Hybrid kind of took on the name because they were being developed right about the time that we started having hybrid cars, right? Cars that used both combustion engines, but also had a battery. So with hybrid long-term care policies, we adopted that name or that genre for them because they were able to do two things for the customer. First of all, they were able to help answer that long-term care need by providing long-term care benefits if the client ever suffered a long-term care event. But what hybrid was also able to do is answer the other two concerns that traditional could not, which was, number one, some of our hybrid offerings can offer you a guaranteed annual premium. So when you implement a hybrid LTC plan, you have a rock solid understanding of what is the premium outlay in order to own that coverage. The second thing that they answered was, what happens if I don't need long-term care? So when you look at the different hybrid solutions that we'll talk about later, you're able to find a measurable outcome, like a death benefit, for example. So if you pay into your policy, you're lucky enough to never need long-term care, then you know that at the time of death, the insurance company has agreed from the beginning to pay your family a death benefit, ultimately allowing you a way to recapture the premiums that you paid on the policy. So it gave you a middle ground that really bridges the gap between doing nothing or buying traditional long-term care insurance. And obviously, when you have a conversation with Kyle, your advisor, they're able to talk about the specific instances in your financial planning that would help you determine, which one of these strategies is most appropriate for you. Now, a common question that I receive is, what happens when you need care? How do you know where you're going to receive your care? And if you are independent in the sense that you are able and have planned to make these decisions on your own or as a family unit with you and your spouse, then you do have options about where you're going to receive care. And let's talk about where you get those and how that progression works. So more than 80% of the individuals that are receiving long-term care right now are receiving that in the home healthcare environment. And it makes sense why individuals would want to receive care in the home environment. You're near your family, you're near your friends, you're near your normal activities. This is the way that typically individuals can get care with the least inconvenience to their family and the least disruptiveness to their schedule and normal way of life. Okay, home health aides, nurses, in-home physical therapists. Really, the industry has moved where they are looking to create more and more opportunities for individuals that are receiving LTC at home because they know it's more convenient. People do better at home. At a certain point, however, though, you may not be able to continue receiving the care you need in the home for a couple of reasons. Typically, it's the services that are necessary and the number of hours necessary. It becomes very cost prohibitive to pay for that type of care in the house. That's when normally what we would see is individuals moving into a nursing home or an assisted living facility, depending on the type of care that you need. The assisted living facility offers help with the activities of daily living, but it's the 24-hour supervision and immediate access to care that really appeals to individuals at a certain point in their care, okay? And when you move into assisted living, that could be you and your spouse, you live together. Assisted living is just like living at home with in-home care. The difference between it and the next step of nursing care or nursing home is what type of acute medical care are you needing? And that may get into a host of different issues. But think about it like this. Most individuals start with home, move to assisted living, and then into the nursing home. The memory loss units are specifically for customers who need long-term care due to a cognitive impairment like Alzheimer's. So when we think about the different reasons why people will need care in the future, you understand that there are two different risks. There's the physical risk of being unable to complete the activities of daily living, but then there's also the dementia and the Alzheimer's cognitive side that is also a concern. When you think about long-term care insurance and the type of plans that could be available for you to use, they provide care in all of these areas. So because you and nor Kyle nor I know what type of long-term care event you may suffer or what level of care you'll need today, we make sure that the insurance solutions that we use cover all of these areas equally so that no matter what you need, you're prepared. Adult daycare is one of the last areas where we're seeing as far as long-term care provided, but in a less independent setting. Meaning if you were to live with an adult child and they were still employed, adult daycare is the type of long-term care where you may go in the morning or picked up in the evening, and then but you don't have the 24-hour services, okay? And again, this is all dependent on what happens in the future, what you may or may not actually events you may actually experience, but ultimately with insurance, you're able to answer all of the key questions to make sure that you're prepared. Now, insurance policies are triggered in two different ways. The first one would be the inability to perform 2 of the 6 activities of daily living. And at this point, if you'll concentrate on the slide, and you'll see those 6 activities of daily living down there on the left. And infrequently do we think about our day like this, but if you were to look at it, all of these activities happen in most instances within 15 minutes of waking up in the morning, okay? And so what you'll find is that when we talk about needing long-term care, the government, the federal definition is the loss of 2 of 6 of these abilities. So when you can't perform 2, that's when an insurance policy would begin providing and paying you a benefit to pay for the care that you're going to receive, okay? The second way that you are able to qualify is due to the cognitive impairment. So again, Alzheimer's is a growing risk and a growing claim factor for many of our customers. And that could be things like medication management, being unable to safely monitor yourself or potentially being a risk at becoming lost or unable to navigate back home. These begin to be the symptoms, and those would also be able to qualify someone for benefits from a long-term care policy. And the way that you go about that and filing the claim is that the insurance company is actually going to use your record from your doctor and your plan of care that the doctor will have created. So ultimately, the insurance company will review the records from your physician as a way to corroborate your current need for the economic benefits from the policy. Okay. And most insurance policies that you own, similar to long-term care, have a deductible. On a long-term care policy, we refer to that deductible as an elimination period. And what that means is those are the number of days from the time that you qualified for your claim that you would be responsible for paying for your own care before the policies kick in. Those are typically 90 days. Some are less, some are zero. Again, those would be the areas that you talked to Kyle about. Frequently with the 90-day elimination period, you probably have a cash reserve, and cash reserves are typically used for emergencies or unexpected expenses like the elimination period. Okay, so when you start really examining long-term care insurance policies, what you'll get the feel for is that these are very defined. The architecture of a long-term care policy, insurance policy, helps you answer all of the key questions that we're talking about as you're really measuring that long-term care event. Okay, so when you and Kyle talk about long-term care planning or a long-term care policy, the features and benefits that you would be defining for your policy are things like your daily or your monthly benefit, meaning in today's dollars, if you needed long-term care, how much each day or month would you want the insurance company to provide you? Okay, you decide that today. And you and Kyle may look at it and you may decide that if in your area right now, home care were to be $6,500, for example, you and Kyle may determine that it's best for you to insure all of that risk. So your policy may be $6,500 per month, or you and Kyle may decide that it's appropriate for you to insure half that risk so that your monthly benefit would be $3,250. It's very certain, it's very dependable, and it's exact. Then you define the benefit maximum, which means duration. How long would you want your benefits to last if you needed care? So we couple what would your monthly benefit be and how long would you wish that benefit to last? And that's how we're able to determine the total sum of your LTC checkbook or your benefit protection. All right. The next decision that you're normally going to make is, do you want that benefit to grow or to remain level over time? And depending on your age when you enter purchasing and the amount of your care that you wish to incur, the expense that you wish to incur on your own, you may or may not wish to use compounding inflation protection. But a lot of the headlines lately have been about what? Inflation. So if inflation creeps into care, then we could anticipate costs going up in that arena, the same that we're seeing in other, domestic demand. So inflation protection makes a lot of sense to make sure that the buying power that you have today remains there in the future. Another decision that you're going to make is, at the time that you're receiving your claim, would you wish for that to be a reimbursement, meaning you have to pay for your expenses on your own and then submit those expenses each month to the insurance company to be reimbursed? Or would you rather have indemnity? Indemnity is synonymous with cash, which means that at the time that you go on claim, the insurance company would simply send you a monthly benefit each month in cash that you deposit into your checking account and simply spend as you need it. Okay, certainly more control, more flexibility with indemnity. But again, these are all of the decisions that you and your advisor can go through in the long-term care conversation and really create that plan that's ideal for you. We talked about elimination period. Elimination period is akin to a deductible, meaning how long from the time that you claim until the benefits start kicking in. Normally, this is 90 days or less on the policies that are used out there right now. If you're married, you could have a shared benefit. This is very attractive due to the efficiency that it provides you by way of premium. Kyle talked about it. There has to be a balance between the planning and the premiums. For married couples, we have contracts that will cover both of you on a pool of long-term care benefits. So this enables you to have flexibility. Maybe one spouse's long-term care needs are a little disproportionate to the other. Maybe one spouse perishes never needing care, leaving all of the remainder benefit to the surviving spouse. A great opportunity and solution to look into for married couples. When we're talking about hybrid long-term care solutions, these are all guaranteed renewable from the standpoint is they can never be changed, canceled. Your premiums cannot be increased after the time that you implement your policy. Insurance company can't reduce your benefits. So predictable, certain, and what will that benefit be to protect you and your family down the road. Long-term care insurance is medically underwritten. So in order to have long-term care insurance, you must qualify for it. The underwriting process takes a look at your current lifestyle and health, as well as takes a look at your health history over the past decade. The process involves an application. It typically involves an interview with a nurse or a health provider. But again, so the healthier you are today, the better off that you are in your opportunity to obtain coverage. But it is dependent on health. Not all that apply can be covered. Now, I think that there are a few different ways that you and Kyle can approach the actual LTC need analysis. The basis is really always getting a good idea of what is the monthly LTC cost in your area so that you can get an idea of what are those future expectations. If we take a look over the last 20 years and we assume that long-term care costs have appreciated at just under 3% annually, what we know with some basic rule of 72 is that in 24 years, a $6,000 expense today is going to look like $12,000 in the future. So meeting with Kyle, understanding where are you today, where might you retire in the future, and understanding what is the cost right now to determine where might that be in the future if your event horizon for long-term care is 10, 15, 20 years down the road. What's your budget, both by way of how much long-term care expenses can you afford to harbor and bear? And what's your budget for long-term care insurance premiums? Meaning if you're still working, you may be preparing for retirement, saving for college educations. So understanding and making sure that it's a budget that's not going to impede your other financial goals is very important. I think the third bullet point is where you and your advisor can have really a conversation that helps create a bespoke plan for you, which is how much of the insurance, how much of this projected cost would you like your insurance to cover? And that is a completely independent answer for every customer, meaning that Kyle may speak with one member who has had a lot of personal experience with LTC. They've seen how expensive it can be, and ultimately they don't want to risk a lot of their personal assets or peace of mind worrying about it. Whereas some customers may say, I only want to use insurance to cover a portion of that LTC risk. ultimately, Kyle can create a plan that fits all of your needs. It's having the conversation, determining where you're at in your finances and what makes the most sense. And that's what Kyle can help you do. And I hope that from this conversation, you're able to contact Kyle, understanding that there are options, understanding a little bit about how we're thinking about it and how it's affecting families. And hopefully this would be a way to really get you started on a productive conversation. Again, speak to Kyle. He'll be the person to help you there. Taking just a quick and closer look at the 3 different long-term care solutions that we use. The first is the standalone traditional long-term care plan. Again, this creates an opportunity for you to have smaller monthly premiums that you can pay from now until the time that you actually use the policy or perish. And those premiums may be tax deductible. Some of the decision points with that type of planning, by spreading out your premiums, you will be potentially subjecting yourself to an increase over time. And with many of those contracts, if you don't use the policy, you may be giving up your premiums. In the middle, we have what we call hybrid long-term care. Again, the ability for you to potentially pay with one premium or a shorter term premium. These policies would offer you a death benefit if you did not need the policy for long-term care. Again, avoiding the use it or lose it risk. And many of these policies also have a return of premium. So if you change your mind along the way, there are ways for you to get your premium back. Okay. The third option is the life insurance with long-term care rider. This is a way where, similar to hybrid, you have long-term care, but you also have a death benefit if you didn't need that long-term care. This example, again, like hybrid, may be a decision based on how much long-term care protection are you really looking for, and are there other goals today or in the future where you may also see the need and the benefit of having the life insurance. But ultimately, what you're seeing with these options is a way not only to get the long-term care, but to get it with predictable, certain premiums, knowing that even if you didn't need it, your family is going to get something back. And I think that that has been one of the keys in helping so many individuals put a plan in place that they know will protect them, but they don't have to have heartburn about it, fearing that they're not going to get anything in return. So there are certainly options out there that will help you do that. And not only would they help you with the long-term care, but we hope you find that they complement your other financial goals. Now, Kyle, that's the end of my prepared speech. I hope that I didn't go too long. I see
No.
I see there may be, and if we have time, and you'd like to, I'm happy to answer any questions if there were any.
Yeah, there were a couple of really good questions that we had. So number one, the first question was, hey, I have a health care policy right now. How do I know if there's long-term care, a long-term care coverage within my current health insurance policy in retirement, right? Many don't, and many of them are unique, but really the best option is to contact your healthcare provider and see, with your plan, what kind of coverage you have, because everybody's going to be individual. Is that about right, Zach?
It is, Kyle. I think that's a great start. And if they have their policy and can, and it's not, 117 pages long, yeah. Kyle, I mean, those are things that we review. So, it may be frequently that maybe you have a member that owns a long-term care policy that they may have purchased a decade ago, and things are a little fuzzy about what worked. And those would be instances, Kyle, where if they'll just get it to you, and then, through the processes, we're able to help review it for you and give you some feedback. So that would be best. Start with your company, and if you're not clear on it, then we could review it for you.
Yeah, exactly. Another question was how many people self-insure versus use a long-term care policy? And this was kind of in the chat box, so I'm just kind of letting everybody kind of know the conversation we had. So looking it up, it seems like about 1 in 30 people, only 1 in 30 people have a LTC policy, but about, 70% of people have a long-term care need in retirement? Is that about right?
Yes. Yeah. I trust your statistic on that, Kyle. That's probably a tough one, but look, it's really, like Kyle mentioned, I've been practicing this for 23 years, and I don't say that to tell you that I know, we've been looking at this, and really at the most 7%. And remember, we have to try to look at that number and say who might own the policies. So we're really not counting people that are 20. We're really looking at that between 40 and those that remain alive. So market penetration's been too low. And Kyle, that's why hybrid long-term care really has been, I think, a blessing for many, because 10 years ago, if you'd asked 10 people in a room, how many of you are worried about long-term care, you would have seen 8 or 9 hands go up. If you would have said, how many of you own long-term care insurance, right? You might have seen 1. So we knew there was a gap in the concern that it created for customers, but their aversion to the solution has really helped us bridge that gap with the hybrid.
Yeah. All right. Well, we have another question from Sharon.
Yes.
Feel free to hop on in here. So what kind of question did you have?
Okay, so I thought I was being so clever. We bought Genworth long-term care policy quite a few years ago, actually. And now they're like, oh, we have so much financial trouble. We're going to charge more. You're going to get less, blah, blah, blah. And my husband is kind of, and I guess they would be willing to give us some money, but it's certainly not probably what we put into it. And he feels, and I think he's probably right, that it would be putting, good money after bad. But I'd like to just have your comment. And I loved Zach's comment about we have an aversion to looking at the solution. I think so. Anyway, thank you.
Zach, I'll let you go ahead and take that.
Yeah, Sharon, I think Genworth has turned out to be one of the worst offenders. Oh, I'm sorry. Has turned out to be one of the worst offenders of the rate increases. They had such a large book of business. They missed on 3 points. They missed on future interest rate expectations. They missed on the number of individuals that would actually lapse these policies because people kept them like they did not want to give them up. And then a lot more individuals claimed than they anticipated. So I don't know, what, those are kind of case by case basis, because for some customers, if their health has changed and they don't have any alternatives as they can even seek, it's important that they keep as much as they can afford. But you're right, because the rate increases have become reoccurring and more frequent, the concern is at what point can you no longer financially maintain the policy? So, it's put you in a tough position. And the sad part is that I believe, in my opinion, Genworth benefits either way because they don't want the risk. So you either quit, they win, you pay more, they win. There's no certainties that they won't. But I think before you quit, we encourage all of our customers to really take a hard look at where will you be without it. Is just like, how do we feel about paying the premium? I know that's been a real bummer for a lot of people.
Yeah, well, I invested in Zipcar too. My choices are all sounded like a really good idea.
That's funny. I know that one. So like Zach said, it's really a matter of taking a look at what you're paying. Can you afford it? If not, what kind of coverage does it have? And is it worth it, right? And that's really going to be a lot of the times a pretty personal kind of decision, and really comes down to numbers, right? Then we have another question. What about someone who is single with no kids? Which type of long-term care plan would you recommend? So Zach, I'll let you go ahead and take it from here. I think I have a feeling I know what you're going to say, but.
Yeah, that's one thing. Even in 23 years, I haven't gotten any better at predicting the future. So, Kyle, that's tough because there might be an inclination to say, at first blush that one is better than the other. But really, I think about it, it's what do you want along the way, right? Even as a single individual, in my opinion, in the planning is we shouldn't think about the economic benefits of like a hybrid. Hybrid has become something to me. I really enjoy it because I see it as an equitable solution, meaning it's fair. It's fair to you if you need long-term care and if you don't. So could a single individual use that? Absolutely, because remember, if you may be charitably inclined, you're going to likely have assets remaining when you perish that will go to benefit someone else, whether it be a synagogue, a church, a university, a charitable cause. So, but, ultimately, I think that, like you say, Kyle, you just have to figure it out together. Cost, how long do you want your benefits to last? Those are some of the things from a single perspective that I think are becoming important more than it's not the type, it's what's under the hood that's going to make the most sense there.
Mm-hmm. Yeah, I think having flexibility is important as well, within policies. Like you said, you can never predict the future. To a certain extent, if you're single and you're younger, you could. There's no law saying that you can't have two different types of policies, right? If for some reason right now you think that you're not going to have somebody that you want to pass the money to, that's fine. As what I've seen as an advisor, as people get older, especially get more towards 80s, 90s, sometimes their thought process changes a bit about what they want and what they want to leave, and so right now it may seem like you don't want that, but you never can tell, especially when you get towards an age where you need to start making some tougher decisions, right? So it really depends, and most of the time our answer is almost always it depends, right? Unfortunately, that really is what it is, because there's no flat answer for a lot of things. We custom tailor kind of solutions that are based on you, how you're feeling, but we can give you some ideas and some suggestions. It's up to you to take them. Zach, this is a good question. What age should someone get a long-term care policy? Is 65 too late? We get this question all the time. And so, Zach, I'll take it. I'll let you take it from here.
Not too late. Not too late. The challenges that you face when you approach long-term care planning later in life is that our health matters more, right? As we age, we typically encounter more health issues that can prevent us from getting care. And then, it's still cost effective. At 65, what we see is that because everybody's living longer, needing care later, 65 is not too late to look into it as long as you're still healthy and that you haven't suffered a big deterioration in your health.
Yeah.
There's a lot of options. The market right now, if you were to go out and try to look at the data, we would find that our average customer is right on the button at 60 years old. And our average customer is 60. So when you think about this market is dominated by individuals between the ages of 52 and 75. I mean, that is the window. And granted, the farther you go, it looks different, but it still makes sense. But this is really about health when you start thinking about your age when you apply.
Next question. So we're talking about indemnity plans, the payment that you get. The question was, do these payments count as income?
From the long-term care benefit? Absolutely not. These are 7702B tax qualified LTC plans. So not counted as income. Currently, the IRS allows you to receive up to $400 per day. Oh, excuse me, $390 per day. So when we start thinking about the, just rough economics, you can receive up to $12,000 per month in long-term care benefit without any federal income taxation.
Okay.
And that's not tax advice. I'm just repeating what I've read.
Yeah.
Okay.
Of course. Another question, premiums for standalone, it was a question about premium costs. So I know premiums for standalone long-term care policy probably vary widely depending on different factors, but I'm wondering what the average premium would be. I'll let you take it if you want to take it. It really will. I mean, it's a very broad brush, but I'll let you take it.
Yeah, it would probably be challenging. So if we defined average with a few certain set of parameters, and I'm going to take a stab at this, but it's really hard, okay? But if we were to say a 60-year-old, and these, pricing is gender specific. So we would, let's say, take a 60-year-old female. If she were to get a policy that offered her $4,500 a month of LTC benefit, if that benefit were going to be 36 months or in duration, meaning that the $4,500 would be paid to her for 36 months at the time that she qualified for claim. And if she added a 3% compound inflation rider, which simply increased her benefit annually by 3% on a compounding basis, if she is a non-smoker of standard health, I would wager that is $2,750
Annually. Got it.
annual premium. Okay.
Perfect. That was great. I mean, to be honest with you, there are so many different variances there. So it's a broad brush. So thank you for taking a stab at it. I appreciate it. Jack, one last question was, please review a quick summary of the difference between hybrid and life insurance long-term care.
Okay, great question. When we talk about life insurance it's really a simple distinguisher. When we think about life insurance with long-term care, think about it as just one bucket of money. So for example, you have a $250,000 death benefit. Life insurance with LTC simply means that during your lifetime, long-term care benefits will be a prepayment of that $250,000 while you're alive. The long-term care benefits are equal to or that $250,000 bucket. When we say hybrid, it's also life insurance with LTC, but the long-term care benefit is a multiple of the death benefit amount. So with a hybrid, we're able to deliver solutions where your long-term care amount is $250,000, but the death benefit amount may only be $100,000. So it's a different way to really create what we would define as an emphasized bucket of long-term care in hybrid Whereas if you're talking about life insurance with LTC, that's an equal balance, right? The death benefit and the long-term care amount are the same. With hybrid, you're always going to have a real bulky LTC amount and then a trimmed down death benefit amount.
Yeah, perfect. Thank you. Can I open a life insurance long-term care for my parents?
Yes, you can. Sometimes, okay, when there's an LTC claim, the insurance company may want to better understand what type of insurable interest that you have in your parents and their care. So, but you could potentially own a policy for your parents where they are the insureds and they would be the triggering individuals for the long-term care benefits. Yeah.
And I think that would be probably a question that we would have to dig into a little bit more because, I think, Zach, you may, correct me if I'm wrong here, it may be more beneficial for them to have their own policies and you give them some money and then they can pay for their own policy that way.
Yes, I think, that probably would be exactly that, Kyle, more discovery on, what's the initial feeling of why we want to set it up that way, right? What leads us to believe that is the architecture we'd like to start with, and then learn more about it to see, can you accomplish the same goal maybe in a cleaner way?
Yeah, exactly. Okay, perfect. Again, same thing if you have siblings, and you guys all want to pool some money together, that gifting might be actually the cleanest way to do that kind of policy, especially if it's multiple people trying to fund that. So let's see here. Josh, are there any other questions that we have? Or is anybody raising a hand or?
Yeah, it looks like Anthony had raised his hand and he had a question. Anthony, if you're there, you want to go ahead and ask?
Yeah, I think I had my question answered, but I'm involved in the Calpers premium rise over a couple this year and next year. That'll probably bring it up about 80% over what I'm paying now. But have an option of taking the premiums I paid, but based on what I've heard Zach say, I'm worried that at 79 years old, I may not be able to buy another policy. Generally good health, do have a heart condition, but I function perfectly well. So I'm just wondering what, if I should just pay the extra or try to seek out something different.
Anthony, hi, it's Zach. Thanks for your question. I'm sorry that you're having to suffer through the Calpers changes. We're kind of painfully, intimately aware of what's going on there. I think that you do fit maybe loosely the scenario I was describing where it's really challenging to determine what your action should be with Calpers until you're able to investigate what your other alternatives are. Right. And your decision now is directly influenced by what those options are. But I can tell you that there are solutions available at age 79. Certainly your health is a big factor in whether or not you'd be eligible. So, if this was something that you wanted to complete discovery on, if you reach out to Kyle and talk to him, then maybe he could kind of help you get a better bearing, which direction might be the right decision for you.
All right, great. Thank you.
You're welcome.
And oftentimes it's it's going to be a math equation, right? A lot of the time, how much, and we would probably start with, hey, if we were to get a long-term care policy, we would probably talk to Zach and the team and we say, hey, what do you think the premium would be, right? And what kind of coverage would we have, right, for that kind of premium. From there we can say, does it make sense to do that? Would it make more sense to self-insure? Family history of long-term care needs is also a point of conversation that we like to have as well. Unfortunately, insurance doesn't get cheaper as you get older, right? And that's just the way it is. When we're at that age, it tends to be, we have to look really closely at what the options are, and what you'd be paying versus self-insuring. So, are there any other and I think we're going to have if any of you guys want to send me an email, or if you guys are interested in moving forward in the long-term care policy, or starting a conversation, just feel free to shoot me an email, and I'll get back to you over the likely tomorrow. Let me see, is there one other chat?
Yeah, real quick, Kyle, if you don't mind including your email in the chat. And also there are some people just on the phone. So can you just say what it is real fast?
Sure. So my email address is kjohnson@calcoastfinancialservices.org. So I don't know if you can maybe able to see that. I have the blur effect on here. So kjohnson@calcoastfinancialservices.org. I'll put it down here in the chat as well, so everybody can see it.
And what's your phone number, Kyle?
The best number to reach me at is 858-253-2690. It's 858-253-2690. I'll put it down there as well.
Awesome. And then it looks like we have one last question from Patsy Coleman. Patsy, are you there? If you're muted, make sure you unmute. We do that all the time.
Yeah.
All right, looks like Patsy may not be available. That's okay.
Okay. Josh, why don't you wrap it up?
Yeah, so gosh, we've flown through an hour, and it's been a lot of great information. I've seen Zach present before, and I say this every time we do a webinar. I always learn something. All the questions really get you thinking. So appreciate all the interaction. Appreciate everyone being here with us, and thank you to Zach and Kyle for presenting today. Awesome presentation, and again, like I said, a lot of great info, a lot of things to think about.
Well, thanks, Josh. And, go ahead.
I was going to say, just as a reminder to everyone, the recording of this session will be on our YouTube channel. So feel free to check that out, and you can catch any info you might have missed. And final thoughts from Kyle or Zach?
No, I just want to say thank you, Zach. Thanks for taking the time here. You guys are, Zach's an amazing partner of ours, and the whole Capitus team are they're fantastic. They know exactly what they're doing, and they're a great resource for us. So, we really appreciate leveraging their expertise for our members, and making sure that we're doing, as Calco says, what's in our members' best interest. So with that, I'll go ahead and sign off. And thanks, Josh.
All right. Thanks again, everyone. Have a great day, and we'll see you next time. Take care.
Thanks.